We just completed our blended retirement system or BRS overview series, and we got several questions about how do you value how much that pension's actually worth? Because a lot of people, may consider separating and they're trying to figure out, what would I need to make on the outside to kind of be equivalent to the value of the pension?
There's a ton of factors that go into this decision, but today we'll break down the financial value of the BRS pension and show you how you can figure out how much more you would need to earn in a civilian job and save to equate to the BRS pension value.
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
Whether to get out or stay in the military until retirement is a huge decision for you and your whole family. And while I think people often think about how much more they can make on the outside, if they're not really thinking about the true value of the pension, they might think that the grass is greener on the other side when it's really not.
Yeah, I know I had several sets of spreadsheets when I was mid-career and, trying to figure out that was based on the old retirement system. And I really hadn't run the numbers on the new BRS until I got a couple questions recently. So I was still surprised that even though you have a little bit lower repayment cap on the newer BRS pensions, that the values are still pretty high, and how much you'd need to make on the outside could be significant if you're in that mid-career phase.
So just to recap, the BRS has a pension available for those who serve at least 20 years. We went through this the last couple of podcasts. Each year under the BRS, instead of the pension, instead of earning 2.5% per year that you're serving, you earn 2% per year. And that's 2% of your high three of base income. So at 20 years, you'd get 40%, and at 25 years, you'd get 50%. But BRS then, in order to make up for that 0.5% differential, there's a matching component to the thrift savings plan, as well as a mid-career bonus option.
Great. Thanks for recapping that. When we think about the value of staying versus going on the contribution side to TSP, that's really not much of a factor in our calculations here. We're mainly going to talk about the pension because most other companies on the outside also provide some type of match in a 401k. So again, to simplify this, we're primarily going to be looking at the pension, which is the big piece. And it's how do you replace that monthly check you're going to get for the rest of your life. Also, it's inflation adjusted, which is kind of a unique thing that even if you got a pension on the outside, a lot of times those are just a fixed amount that stays the same over your life, or maybe has a small fixed COLA that it provides. So how do you think about valuing a pension?
Yeah, so the biggest, one of the biggest components of the value of your pension is, how long you live. But absent kind of knowing those things, we can make some assumptions, and we can go out and use some products to kind of get an approximation of what your pension's worth. And one of those products is called a Single Premium Immediate Annuity, or a SPIA. This is where an insurance company takes a lump sum of money from you. So you pay them a lump sum of money, and in return, they provide you a contract that promises to pay a certain amount of money each month for the rest of your life. Now, most SPIAs don't have an inflation-connected component, but they might have something where you can get like a 2 or a 3%. I've seen some as high as a 5% increase annually, but you've got to pay for that.
The other thing we really don't know is what your pay is going to be exactly when you retire. Since it's inflation adjusted, we can really use today's pay table and then make some additional assumptions and calculation. We're going to start by looking at the pay table for people who would be retiring this year. So we'll look at an E7 retiring with 20 years, an E9 with 25 years, an O5 with 20 years, and an O6 with 25 years of service at their retirement dates. So an E7 with 20 years will get about $27,000 per year in retirement benefits. For the E9, that goes up to about $38,000. An O5 at 20 years would get $52,000 per year, and an O6 at 25 years would get about $62,000. Now that we know how much we'll get, we can see how much that would cost to buy a SPIA, as Amy talked about, that pays that amount. And there's one other critical data point that we need, Amy, for that.
Yeah, and that's your age, because insurance companies are basically, they use tables to determine what your life expectancy is, meaning how much they think they're going to have to pay out over your lifetime. So we'll have to make some assumptions about how old you are when you're retiring. So let's just assume that the E7 is 40, the E9 and O5 are 45, and the O6 is 50, just to keep the numbers nice and round. The other assumption that we'll need to use is that payments are going to be adjusted with a 3% COLA each year. That's about what it is these days. That may not always work out, but it's close. So Mike, if you go out and you grab quotes for a SPIA based on the information that we just talked about, what do the quotes look like?
Yeah, so the quotes, again, with the COLA that Amy talked about, the approximate cost for those would be, for the E7, it'd be about $800,000. For the E9, about $1 million. The O5, $1.4 million. And for the O6, $1.5 million. Now, what I'd say about these is they're very sensitive to interest rates and the COLA assumptions. You could easily see these, values change by probably 25% or more, up or down, depending on those factors. And then again, age also, affects that. And then the other thing is the ratings of the insurance agencies that you're using. Again, these are ballpark numbers on what you can probably expect if, again, you're retiring today and had to try to buy a pension that would meet those same numbers.
Yeah, and I mean, let's just talk a little bit about the interest rates. We're, in what feels like a high interest rate environment because, for the last decade, so the 2010s, we had very low interest rates for a long period of time. So a lot of people are feeling like we're, way off the reservation with today's interest rates, and that's kind of not true. We're more in the normal realm of interest rates now. Having said that, when interest rates are higher, it typically means that inflation's a little bit higher. And if your annuity is pegged to, say, that 3% that we're using, but inflation's higher than that, then you're losing purchasing power. Depending on how things are going, the annuity is about the best approximation that we can get for a simple comparison or a simple explanation of what your pension is worth. But like Mike said, just know these are not exact numbers. But let's just take the numbers as they are. And these numbers are in today's dollars. So, even though we're talking about people retiring today, let's rewind the clock. You are, say, let's just for the sake of argument, say you're at year 10 or, 12 or, maybe you're at year 5. That means that, you have a certain number of years to be able to save the amount of money that you would need in order to purchase one of these annuities to replace your pension if you were going to leave and go to the private sector. And so what we have to figure out is how much would you need to save between now and the time when you would be retiring so that you could, kind of replace the pension that you're choosing to leave behind. So Mike, you want to walk us through how to think about that?
Yeah, so for this, we'll just pick the lieutenant colonel, say they got 10 years left and we're wondering, should they stay? We said we've assessed that it's going to be about $1.4 million that they'd need at retirement, in today's dollars to buy that SPIA. We need to increase that over time by the amount of inflation that will occur over those 10 years while he's still in. So some of the assumptions, basically the extra money you're going to get is going to go into an investment, 7% return on that investment, and then we're going to stick with the 3% inflation over that time. Also, part of the assumption is that you're going to be getting, probably about cost of living adjustments each year in your jobs. You'll continue to increase that investment every year for those 10 years at the same 3% rate. So running those numbers, you would need to start investing about $110,000 if you had 10 years left before you retire, to make sure you had that money over the next 10 years to buy the annuity. Again, $110,000 for that '05 that's considering retiring. Amy, what are your thoughts on that? Surprised?
Yeah, I mean, a little bit. Obviously, I do this. I run into clients that are thinking about going to the private sector. They want to see a comparison. So a little bit surprised at how big the number is, but not completely surprised. But this is, I see different situations. But I'm guessing our listeners might be pretty shocked and might be wondering where they're going to find $110,000. Now, if you're pretty early in your career, you've got more time to save. So if you, for example, if this person was at year 6 of service, they would have longer time. So 14 years to save up money. So that they would only quote, only need to save about $70,000 per year. And that's just, it's still a lot of money. So when you're thinking about leaving and going and getting a bigger salary, you need to know that salary has to be substantially bigger, and you have to save it in order to make the pension replacement work.
Yeah, and that's a great point. You actually need to save it. And again, the time factor is huge. The more time you have, of course, the more time you're going to have for it to grow. So that's really the key to this. So the other thing we need to talk about really is taxes. And, there are really several things to consider. The first factor that will actually increase these numbers is the fact that you have some additional tax advantages as a military member because you don't pay taxes on your housing allowance or your subsistence allowance. So if you get out of your tax, all of your income is going to be taxable. So that could actually drive, some of these numbers even higher from 110 to maybe 115,000 a year additional that you'd need to make.
Yeah, that's a really great point. I mean, and we see this time after time. When you leave the military and you get another job, we often see people jumping tax brackets. And this could happen even if you don't have a pension. So if we assume, if we're assuming that you're going to invest $95,000 a year, you're saving $95,000 a year. Most of that has to be after tax money because you're not going to be able to put enough into a tax advantaged account like your 401k or your IRA. You're going to have to put a lot of it in a taxable account. So it's after tax money. And really what that means is that your salary might need to be, $120,000 more than your military salary. So that after you get done paying taxes, you still have that $95,000 a year to invest. That's a lot of extra money.
Another big thing is all of this is just to stay even with your current military benefits. It's not to, an increase in lifestyle and things like that. It's just to basically stay where you are if you, stay for those next 10 years. The other big value that we have in the military is healthcare. And it's a little hard to come up with a number on this because most private companies, bigger firms, offer some flavor of healthcare. Now, you're probably going to be paying part of the premium, and that can vary widely. And then if you get a more like a contractor job or you start your own business where those aren't going to be provided for you, then you're talking tens of thousands of dollars a year that you're probably paying for you and your family for those. The other piece where the pension or where the TRICARE really comes into play is if you want to retire early. Everybody will get on Medicare at 65, but if you say want to retire in your early 60s, there's a few years there where if you get out and work for a civilian company, you're going to need to be paying, either on the healthcare exchanges or finding some other coverage for you, or maybe your spouse is still working and can use that. But if you both want to fully retire in your early 60s, the healthcare benefit that you get from retiring is huge.
Yeah, and just to try, tag on to that. So, when you do get to be 65, so, if you leave the military and you're not under TRICARE for life when you're 65, so Medicare has picked up, you've got Part A, Part B, Part D. There's premiums for 2 of those parts that are based on your income. In addition, because those things don't cover everything, A, B, and D, they don't cover everything. So a lot of people add an additional sort of either a supplement or a Medicare Advantage plan. Those premiums can be upwards of $1,000 a month. For TRICARE for life, you're only going to pay Medicare Part A, which is generally free for most people, and then Medicare Part B. You don't need to pay for another supplement or a Medicare Advantage plan. So that is a huge deal. And then the other factor is, VA disability. So, in my experience, most retirees are going to qualify for some level of disability after 20 years in the military. It just beats up our bodies. So you can also qualify if you separate earlier, but there's a better chance, there's a good chance that if you're serving for a longer period of time, you're older, there's a good chance that your rating is going to be a little bit higher if you stick around. So essentially that could mean, several $100s more in tax-free income each month, or, upwards of, a few $1,000s in a year.
Yeah. So now we talked about being pretty advantageous to stay till retirement. But there are definitely some caveats and considerations when you're thinking about this decision. The first one I'll hit on again that we talked about is, these are pretty broad numbers. Again, I'd expect them to vary 25% either way, again, depending on the situation when you're actually retiring or looking to get out. So make sure you don't go, Mike and Amy said it's, $110,000 per year, and that's exactly what it is. It's going to vary, based on your age, your health, and all those other things that go into planning. So, and then investment returns, inflation, taxes, all those things we can't know about now. So, Amy, what are some other things besides those kind of big caveats?
Yeah, I mean, so we talked briefly about taxes. Military pensions are fully taxable at the federal level, and by some states as well. In our example, we're assuming that you have to save in a taxable account to buy the annuity. So that means that for the annuity payments, you would actually be receiving some of that money as a return of capital. So meaning that it's already been taxed, it's not going to be taxed again. So theoretically, your tax bill could be a little bit lower. The differential may or may not be as big as the differential that we talked about in taxes when you leave the military. So it's not a one-for-one trade-off, but there, it is a consideration that annuity could be taxed a little bit more favorably than your pension.
Yeah, and another thing, you've got some flexibility if you're saving on the outside. You don't immediately need to buy that annuity at 20 years, what would have been your military retirement time. So that is one nice thing. For the military, you're tied to the pension, it's tied to your life. And, it ends when you die, outside some other factors. But, if you invest well and can keep it growing for another 10 years, or longer beyond, when you would have retired, maybe you can make up more of that difference at that point.
Yeah, and another thing is that it's not always all about the money. There's a lot of reasons that it might be better for you and your family to get out. Military life is rough. It's hard on the whole family. You've got moves, you've got deployments. If you're able to get out and stabilize in one single location, or at least not move as often, that could be worth a whole lot more to your family and to you than a pension. It might also allow your military spouse to pursue more stable income or more stable employment, which could offset some of the value of the pension. So with that, Mike, any other thoughts to kind of wrap up?
Yeah, those are all great points. I guess I was kind of surprised, how much the value is even under the BRS. That was one of the concerns when people talked about this was, you're taking that away. I think specifically on the officer side, they really still are kind of golden handcuffs that you hear about. That it's going to be hard to, as you get into mid-career, find something else that's going to make you enough to kind of replace that full pension, which is kind of interesting because my old career field in the Air Force, which was cyber, just announced some new bonuses for cyber officers, I guess, to keep people in the career field. And, they've got two kind of tranches of cyber. And for one, they're targeting officers in the 9 to 15 year range. And the other between 7 and 11 years with, $100,000 over 4 years, which I mean is great, and hopefully gets more people to stay in. But based on this, I think targeting them earlier, may be better. And then I think for the 10 years and beyond, DoD should really just develop a calculator with all this information in it and, just send that out to people as they come up on you get your annual statement of compensation where they say, oh, the tax rate, tax free is worth this and your bonuses are this and the commissary is worth this much, add this on there that, oh, that pension, here's how much it would really cost you to go out and find that. I don't know that they ever will do that just because there's a lot of assumptions based into that. And it's not as easy as a single year snapshot, but I think it's kind of interesting when you actually do run the numbers, how much the pension really is worth.
Yeah, I agree. I was also surprised to some degree. Um, just one final note to wrap up. It's important that you do your own calculations. Like Mike said, there's a ton of assumptions in there. You need to make sure that the assumptions apply to you. Also, keep in mind, we used an annuity as sort of a proxy for the calculations. That's not a recommendation that you replace your pension with an annuity. There could be other ways, better planning methods, other tools for you to use in planning your retirement if you plan to leave. That was just sort of a good way to frame this discussion. So not a recommendation. You definitely need to get some advice unless you can do all of this on your own in terms of doing the calculations, getting comfortable with assumptions, and make sure that you understand how everything is coming together and how it unfolds over time. So with that, Mike, I think we're wrapped up and we'll talk to you again in a couple weeks.
Sounds great. See you then.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com.